$1 trillion. That's the number we have to start with today.
It's a staggering figure.
In just 1 week, an ETF that tracks the U.S. software sector, it didn't just slide. It basically evaporated. $1 trillion of value just gone.
Right. And if you only looked at that number, you'd think the entire tech world was on fire.
But that's the trap, isn't it? Because at the exact same moment, software stocks are bleeding out. The hardware giants, the ones actually building this stuff, they are spending money at a pace that's just unreal.
It creates this sense of vertigo. This is what we're calling the AI divergence.
Right.
It's the central tension right now. You've got investors punishing the companies that make the software, but they're rewarding the ones who create the plumbing to run it.
So it's a massive reallocation of capital.
A huge one. And it signals that the market is finally realizing that this AI transition, it's not going to be some smooth software update. It's a messy, expensive industrial construction project.
So we need to figure out why the market is essentially saying software is dead, long live hardware. And the best place to start seems to be with the CapEx king of the week, Alphabet.
Yeah, their numbers came out and the reaction was, well, complicated is the polite word.
Right.
I mean, revenue was up 18%. In any normal year, for a company that size, that's a blowout quarter.
Sure.
But the market just completely ignored the top line. They zoomed in on one thing. Capital expenditure.
CapEx.
Alphabet is pouring billions into what they're calling aggressive CapEx to boost their AI capacity.
And just to make sure we're all on the same page, when we say CapEx here, we're not talking about, hiring more salespeople or marketing.
No.
We mean spending on physical assets, hard stuff.
Exactly. We're talking data centers, custom silicon, heavy copper cabling, massive cooling systems. This tells us we are still firmly in that infrastructure build-out phase.
Like the red.
It's a perfect analogy. Alphabet is spending a fortune laying the track across the continent, but we haven't, quite figured out how to make a profit on the trains yet. And investors are getting nervous. They see all this cash going out the door, and they're asking, when does it come back?
That's the disconnect. So Alphabet says, we're building, but then you look at the chip companies who are supposed to be benefiting, like Qualcomm and ARM Holdings, and their guidance was surprisingly tepid.
It was. Qualcomm missed its revenue expectations. ARM is seeing slower growth.
So if Alphabet is spending so much on infrastructure, why aren't the chip designers throwing a party? Shouldn't they just be swimming in cash?
You would think so. But this is where the nuance of the hardware supply chain really bites you.
Okay.
It isn't a lack of demand, it's a failure of supply. Qualcomm specifically flagged a bottleneck in memory chips.
Walk us through that mechanism. Why does a memory chip shortage hurt Qualcomm specifically?
Okay, so to run advanced AI on a smartphone, which is Qualcomm's bread and butter, you need very specific high-performance memory chips. You can't just use the old stuff.
Right.
But the memory manufacturers, the global giants like Samsung and SK Hynix, they've pivoted their entire production lines to make HBM high bandwidth memory.
For NVIDIA's data center GPUs.
For NVIDIA's massive data center GPUs, the stuff Alphabet is buying.
So because NVIDIA needs all that capacity for the big data centers, there isn't enough production line space left for the smartphone memory.
Precisely. It's a crowding out effect. The manufacturing capacity is finite, and because the margins on those data center chips are so juicy, the memory makers are prioritizing them.
So Qualcomm is left in a position where they literally can't get the parts to build the chips to go into the phones.
It's the classic, for want of a nail, the kingdom was lost. Except here, it's for want of a DRAM chip, the revenue guidance was missed.
And that drags down ARM Holdings too then, because they get royalties on the chip designs. If chips don't ship, ARM doesn't get paid.
Exactly. It just highlights that the AI boom isn't a straight lineup. The supply chain is messy, it's clogged, and it's effectively cannibalizing itself. The resources needed for big AI in the cloud are starving the edge AI on your phone.
Speaking of cannibalizing, let's go back to that $1 trillion loss in software, the so-called software panic. The narrative seems to be that AI is going to eat traditional software companies alive. Why is Wall Street so terrified of the SaaS model all of a sudden?
Well, it comes down to the fundamental unit of value. For the last, 15 years, software as a service was the golden ticket.
Right.
You charge a company based on seats. How many human employees use the software? Salesforce charges per user. Adobe charges per user. It's a headcount tax.
And investors love that recurring revenue model.
But now, you imagine an AI agent can do the coding or the graphic design or the data entry. If an AI agent replaces 3 humans, the company fires those 3 humans.
Which means 3 fewer seats for the software company to charge for.
And that's what the market is waking up to. The realization that AI might actually shrink the total addressable market for traditional seat-based software. The efficiency of AI could be a death knell for that pricing model.
If you make a company more efficient with fewer people, you end up selling less software.
That's the fear. Now, you had the CEOs of NVIDIA and ARM out this week trying to, talk the market off the ledge.
Sure.
They're arguing that AI will expand the pie, that will just consume more software and more compute, so it'll all net out higher in the end. But investors aren't buying it. Not yet.
They see the CapEx kings building the brain, and they see the software companies selling tools to humans, and they're betting on the brain.
It seems so. Unless apparently you're Apple.
Right. In a sea of red ink, Apple was green. They're defying this software as dead panic.
It's the safe harbor thesis. And the logic, when you think about it, is pretty simple. It doesn't matter which AI software wins or which agent takes over or whose model is smarter.
You're probably going to access it through an iPhone.
Exactly. Apple owns the distribution. They are the toll booth.
So while everyone fights over the engine, Apple owns the driveway.
Pretty much. And you saw a similar contrast with Snap and Sony. Snap beat revenue but missed guidance. Kind of the same old story there. But Sony crushed it.
Why Sony?
It's a perfect example of why diversified hardware helps right now. They make the image sensors for cameras, including in iPhones, and they have that massive music catalog. In turbulent times, hardware components and IP rights, like owning the Beatles catalog, they hold up much better than pure software code.
Real things have real value when the digital world is in flux.
That's it.
Okay, so the supply chain is choking on memory chips, and that's creating this existential crisis for software. This memory shortage actually bridges us to our next nightmare, the geopolitics of hardware.
It does. Because if Qualcomm can't get chips, where do they go?
And it's not just them.
No. We're hearing that HP, Dell, Ace, all the big PC makers are running out of memory chips. They're getting desperate.
Yeah.
And the signals this week are that they're considering what was, until recently, unthinkable.
Sourcing those chips from China.
Sourcing them from China.
Why is that so unthinkable? I feel like everything I own is made in China.
Not in high tech. Not anymore. I mean, the US and China are in the middle of a messy divorce on semiconductors. We're actively trying to cut off their access to advanced tech. The message from Washington is clear. De-risk, decouple, get out.
But now, because of that supply crunch we just talked about, Western companies might have to go crawling back to Chinese suppliers just to keep shipping laptops. It completely undermines the national security strategy.
It does. It gives Beijing massive leverage. And the Trump administration knows this. We're seeing some moves that suggest they're trying to flip the script and use chips as a bargaining chip of their own.
You're talking about that NVIDIA story with ByteDance.
Yes. ByteDance, which owns TikTok, is theoretically on the naughty list. But there's a potential move to allow them to buy NVIDIA's ultra-powerful H200 chips.
Wait, I thought the whole point of the ban was to prevent China from getting those specific chips to train their AI models.
Right?
Why would we just hand them the keys to the kingdom?
That was the old strategy. The new strategy seems to be more transactional. The reports are saying there are conditions attached to this sale that China hasn't accepted yet.
So it's a carrot.
It suggests the White House is using the H200s as a carrot. You want the chips? Give us something on trade. Give us something on Taiwan. Chips are becoming a diplomatic currency.
Meanwhile, the company that actually makes all these chips, TSMC, they're quietly trying to get out of the line of fire.
They are. They just announced a massive $17 billion investment in Japan to mass produce 3nm chips.
3nm, that's the cutting edge. That's the brain of the iPhone.
It is, and putting it in Japan is a strategic hedge. If China blockades Taiwan, the world stops. If TSMC has a fortress in Japan, the global economy might just survive. Japan is rapidly becoming the backup hard drive for the global semi-industry.
There was one other stat in the China file that really jumped out at me. We talk constantly about how much energy AI uses, how data centers are sucking the U.S. grid dry, but China is apparently winning that race.
They are. China is adding new energy capacity specifically for AI data centers faster than the U.S. is. This is the bottleneck that nobody talks about enough.
Right.
You can have all the NVIDIA chips you want, but if you can't plug them in because your local utility takes 5 years to build a substation, you lose.
So China's building the power plants now.
They're treating energy availability as a national strategic asset for AI dominance.
Okay, so we have a hardware arm